Okay, everyone, it's 2 o'clock on the dot, and we are ready to begin our director's cut for May, looking at March production figures. I hope it is as lovely in your part of the world as it is in our part of the world in Bismarck today. Just remember, keep it on topic. If you're new to the call, use the chat feature as a way to ask questions. Those are my main ground rules. So with that, I hit record, and then we'll turn it over to Mr. Helms.
Thanks, Ellie, and welcome, everyone. Thanks for coming. It is a beautiful day in North Dakota. Very little breeze and nice, warm, sunny day. And webinar, the production numbers are a whole lot like that, too. We had a very slight downtick in production February to March, down 1%. Gas production was up 1.4%, and that's, again, that completing wells in the core of the Bakken. They make more gas, and so really, essentially no change there. We did hit an all-time new high in terms of the number of wells producing in North Dakota, and we had a very large drop in the number of wells waiting on completion. That really stabilized things. The last time we had a triple-digit drop was in October of 2015, when completion wells waiting on completion went down 105. So this is the biggest month-to-month drop in wells waiting on completion we've seen. And even larger than that was people putting inactive wells back on production. Over 300 wells that had been gone inactive in December and January came back on production in March. And last time that we had less than 700 wells waiting on completion was in October of 2014. So all of that's pretty good news. The flaring is good news, down just slightly, but on target, well above the numbers that the Industrial Commission has set for industry to achieve flaring-wise. There are a few things of concern, though, and I want to talk about them. One of those is that OPEC meets the end of this month. And the production cuts that they implemented will expire the end of May. So they have an enormous decision to make. And for a long time, I've been hearing that it was pretty much a certainty OPEC would extend the production cuts. But with the activity in the Permian and the oil prices doing what they're doing, there's beginning to be some doubts and some concern about that. The Permian Basin in Texas is interesting. It's the newest shale play. So North Dakota and the Eagle Ford, pretty mature. Been adding about 2 drilling rigs every month for the past year in North Dakota and the Eagle Ford. That was plays 1 and 2. Oklahoma was play number 3, and they've been adding about 5 drilling rigs each month over the last year. Permian, they're acting like it's 2012. They have been adding 15 drilling rigs per month for the past year. And their production is up almost 450,000 barrels a day, and it is a real concern to our OPEC friends. So there is some concern, with the North American shale plays acting like that, whether OPEC will decide that we need to take another hit. And I think, we should really be watching out for that. Also, a lot of activity on the BLM venting and flaring rule this week, as you full well know. The CRA, or Congressional Review Act, failed in the Senate, 49 to 51. And so we've re-upped with the court, and the federal court in Wyoming has now put out their briefing schedule, and they've accelerated that briefing schedule because the rule is in effect. And it's going to stay in effect unless it's overturned by the court. And there is no preliminary injunction. So beginning in January, it starts to have a real dollars and cents impact on the state of North Dakota. And we're already starting to see it a little bit in the gas capture numbers. You can see that gas capture numbers have been doing extremely well, except for Fort Berthold. And Fort Berthold, where really the consolidated high gas producing federal lands are, has fallen out of bed. They're sitting down there at 85%, which is the minimum gas capture goal. The rest of the state is running 90 and 91%. So that there's a significant issue there. I guess actually the rest of the state is running 92%. So we're going to see an accelerated briefing schedule in the case. Judge Skavdal has assured us that he's going to get a decision out before the rule begins to have impacts in January of 2018. So there will be a lot of work on the part of the Department of Mineral Resources and our outside legal counsel on that case, and that is a very, very significant issue. Really what's at issue is that in January of 2018, the Industrial Commission will have a gas capture rule of 85%, and the BLM rule will not have one, but it'll be in effect. October 1st of next year, the Industrial Commission will have a gas capture target or rule of 88%, and the BLM will be at 85%. And it's 6 years before they catch up with us. So for 6 years, on federal lands, operators will be able to flare significantly more gas than they can on state lands. And so there's going to be an issue, a tug-of-war, I guess, basically, between North Dakota Industrial Commission rules and BLM rules. On the hydraulic fracturing, there's real progress. BLM has said that they're starting the process. They have requested that the appeals court hold the appeal in abeyance, which means just freeze it, set it off to the side in the don't do anything pile, and wait for us to write a rule eliminating the existing rule. And then the last federal thing that I wanted to talk about was there's still about 1 week for you to get your comments in on the PHMSA petition that they received from the state of New York to impose a Reid vapor pressure limit on crude oil moving by rail. We also published new break-even numbers for this quarter. Not a lot of change, $1 and $2 changes, with a couple of exceptions. Golden Valley County saw a big improvement. They brought on a few good wells out in Golden Valley County, and that better production dropped their break-even number. And let me see, Divide County and Burke County went the other way. They went from $78 a barrel to over $100 a barrel. The production up there is just lagging, and there really is little to no activity in Burke and Divide County. 0 rigs in Burke County, or in Divide County, 1 rig in Burke County. And it's actually drilling in the Mission Canyon using Bakken-type technology to start applying it to our traditional big producer, the Mission Canyon Formation. So I know it's some other folks' theme songs, but we're just waiting on the world to change. And that's really all that I specifically had to say, but I'll take questions.
Okay. The first one from the webinar. McKenzie County has oil production rising 11% from February to March. Any idea what's behind the increase in McKenzie County production?
Sure. It's those non-completed wells coming online. I don't have the exact number, but well over half of that 110 wells were in northeastern and eastern McKenzie County. So that's where we're seeing the increased activity, increased rig count, increased well completions, and highly productive wells. There's some issues with gas gathering in that area. They're running right up against the limits in some cases. But some good news is that the Lake Sakakawea crossing for Hess Corporation is now approved. They've got some geotechnical work to do around those pipelines and a little bit of erosion protection to install this summer where those pipelines come up out of the water. But they should be fully functional by this fall. And they have a 5-year window to use those existing pipelines and then decide what they're going to do with them. So,
I'm sorry, when was the Hess approved? Is that recently?
Oh, yeah. The question from the room is, when was the Hess pipelines approved? and that was within the last month, yes. So that was waiting on approval from the State Water Commission, and they approved the 5-year window, but they do have to, right now they've got divers in the lake looking at the lake bed and how much cover there is over those pipelines, and they've got a plan in place to put concrete mats at the water's edge to control erosion, and they're looking at the possibility of using those mats for pipeline protection in the lake bed. It's something that oil companies have used in the Gulf of Mexico for a long time. There are these massive mats of concrete squares that are all connected, kind of like chainmail, and you can lay them on a lake bed or on the ocean floor relatively easily, and it stops erosion.
With the reduction in uncompleted wells, do you see production declining in the next few months, or will that be offset by the rise in the number of rigs?
Yeah, so great question. And it looks like from the data and the information and from what operators are saying about their activity over the summer, that in the near term, production should be steady or maybe up slightly over the April, May, June timeframe. So I think we're actually, I know I predicted we might still go back below 1 million, but I think we probably got that behind us. And so as long as oil prices don't take a dive, it looks like we should be staying above that 1 million mark and maybe increasing in the near term over the next 3 to 4 months. The dangers in the oil price and in what OPEC decides to do in response to what's happening in the Permian.
Can you explain why McLean County's break-even price is lower than McKenzie's?
Yeah, McLean County's break-even price is really dependent, and we're a bit at the mercy of statistics. McLean County has very few wells. Let me look it up here. They've only got 64 wells capable of production and only 46 producing. So when they bring on 3 good wells with an IP of between 2,000 and 3,000 barrels a day, their break-even prices are affected a lot. So they don't have very many rigs, they don't have very many wells, and a few good wells like they've had over the last quarter change things completely. So, and those are wells going under Van Hook, under the arm of the lake there. There are, I think, all 3 of those are 3 or 3.5 mile laterals. So they're pushing the limits of the technology, but with the added stages and the massive fracs, they're very good wells.
Have you seen any clear impact of OPEC supply cut on North Dakota supply? Would we still be above 1 million barrels if the deal hadn't happened, or how far might supply drop if no extension is reached? So kind of all things OPEC.
Sure.
There.
A little bit complicated as far as a question. I think the early increase in rig count that we saw was a result of the OPEC cut. OPEC made the cut in November. This last week, we saw a $5 million draw on crude oil inventories in the United States. That's a real positive sign for prices. And industry was very careful with their capital expenditures in 2015 and 2016. So they came into this year with strong balance sheets. I think they were looking at getting to 50 drilling rigs by the end of this year, and they went there in February or March as a result of the OPEC cut. Now, whether OPEC sees that as a successful plan, because it gave them a very nice bump in oil price, but that has since dissipated with the increase in Libyan crude production and the increase in the Permian Basin. And so there's a few options for them. One is to go to deeper cuts. That's going to be a tough ask. One is to maintain discipline, and then the other is to say, hey, these folks out in the Permian are new companies in a new basin. They need to learn the lesson of the other shale plays, and everything drops to $40, which would take rigs out of our market and put us back in decline. So it's really a time of uncertainty. And by the time we talk next month, we'll know what OPEC did.
That is true. That is true.
With the, you mentioned the CRA failing. Can you explain a little bit more about how that could put the state at a disadvantage in the future, and what the industry might look like if nothing changes foreseeably? Sure.
So the question was kind of near-term and long-term impacts of the failure of the CRA. The near-term impact is, of course, that Secretary Zinke has promised that he's going to undo the venting and flaring rule. As far as the state is concerned, the immediate impact really happens January of next year. So for the remainder of this year, the only impact is uncertainty. And I've already had people in my office, and there are people coming in over the next couple of months, gas gatherers and operators, talking about gas capture plans, and they're very unhappy about the differences and the uncertainty. So we have seen another uptick in terms of people getting out of federal lands, transfers, sales, especially where we've got a gas capture problem. And so we've got a couple more operators now that are unloading properties on federal lands and shifting their operations to private and state. When we looked at the economic impact of all of that, once we get to January of 2018 and beyond, it looks like the state could take somewhere in the neighborhood of $150 million a year hit in terms of royalties due to decreased activity and shifting of operators and increased flaring as people switch. Natural gas prices are really struggling, and so there's a lot of pressure to go to flare. So what people are going to be strongly motivated to do is flare as much as the BLM will allow, which is more than what the state will allow. So when you factor all that in, starting January of next year, it starts to cost the state $10 million a month in taxes and royalties. And up until that time, it's just the uncertainty, and there's going to be a lot of activity on our part with people selling their federal properties and getting out of that part of the business. And the people who are buying them are private funded venture capital firms with not a lot of oil field experience. They're not oil companies.
Maybe, and you might have answered this question with that previous answer, but I'll ask it if you have anything else you want to expand on. How much of a hardship will the BLM flaring rule really be? It's less stringent than the requirements for the rest of the state, right?
That's correct. It is less stringent than the requirements for the rest of the state. And for us, the hardship is going to be trying to balance out or average out the gas capture for companies that operate on and off of the federal lands, because we're trying to apply our gas capture rules everywhere. Where we're running into some problems is that's really not going to work. We're not going to have the authority in many of those spacing units where there are federal lands to actually restrict production. And so it's going to be a long and difficult dance with the operators and with the BLM working through this. Spoke to the BLM office. They're pretty unexcited about enforcing this rule. They're getting behind again on drilling permits with the increased drilling activity, and now they're going to have a new, and they haven't had any increase in staff, and now they're going to have something new to enforce. And so we're going to have a continuous month-to-month discussion with operators about which gas capture percentages they have to achieve and whether we can impose production restrictions to try to keep their average gas capture above the state number.
So, I mean, really, and you might have hit it too, but let's just be sure, would the state NDIC capture rules be enforced after January 18, or would the BLM rule take priority?
We're going to try to enforce our gas capture rules on a statewide basis, but it says right in our rule and statute that the federal rule takes precedence in a federal CA. So I guess there's really no question that the federal rule is going to have precedence in a federal CA.
So this is probably an obvious follow-up, but that sounds like it could be a disincentive for people to put in gas gathering systems and potentially gas processing plants.
Yeah, the question was, does this create a disincentive to make investment in gathering and processing? And absolutely. You know, we factored that into our $10 million a month cost, that it is going to reduce significantly the incentive to put in the time and effort to get BIA right-of-ways and to spend the money to expand and loop pipelines and to add compression and processing.
Do you want to just let folks know what a federal CA is and means?
Oh, I certainly will. What is a federal CA? A federal CA is CA stands for Communitization Agreement. And pretty much what it is, it's the same as a pooling on the state side, where all of the mineral owners and working interest owners within a spacing unit are communitized or pooled together. So it's one pot of money, and it's divided up based on how many mineral acres you have in that pot. And annoyingly to a lot of people, even though the state sets the spacing unit and pools the spacing unit, you still, if there's any federal minerals in there at all, have to send a bunch of paperwork to Billings, Montana, and get them to process a communitization agreement for what's already been spaced and pooled. And then, under this new rule, they're going to take over how the oil's measured, how the gas is measured, and how much you can vent and flare.
Okay.
Going back to OPEC, if they do get rid of all the cuts, what is the worst case scenario for the Bakken?
Sure. The question was, OPEC decides not to extend the cuts. What does that mean for the Bakken? The research that I have read says that the non-cut floor for oil price is about $40 a barrel, West Texas Intermediate. That puts Bakken oil prices now down in the $35 a barrel range, and that really puts things in neutral again. I think you would be talking low to mid 30s for a drilling rig count, back to 1,000 or more uncompleted wells, and people just saying it's not worth investing, it's not worth producing at this low price, when in a few years the market is expected to balance and we can be back in business. So the research shows about a $40 WTI. That puts us back into the 30s for a rig count.
And here's another Captain Obvious question, just for fun. It seemed, at first blush, to somebody just looking at it from the outside, it would seem counterintuitive that we have a record number of producing wells, but actually we're producing a little less oil. And I guess the explanation probably is, correct me if I'm wrong, that some of the higher producing Bakken wells are starting to lowering, they're starting not to produce as much. Would that be fair?
Yeah, good question. It seems a little counterintuitive, as was asked in the room, for us to have a record number of producing wells and yet not be at record production, because we were at over 1.2 million a day. And you're right. The couple of things are happening there. The Bakken wells are beginning to show their age, and that record number of producing wells was driven more by 300 idle wells coming back on than it was by 110 new completions. And so we're seeing fewer brand new high productive wells and more of the older, somewhat declined, somewhat aged wells that don't produce as much. So.
Okay. We're getting on just a few minutes left, so I've got a last question from the webinar. Without an OPEC cut, 30 rigs, 1,000 completed wells. What's the magic production number?
What's the magic production number? Well, we head back for 900,000 is what happens. And I think we built that into the revenue forecast. So that really is the basis of that revenue forecast that we put together for the 2017-19 biennium, which was 925 and 950. It'll be a dip, and then we'll have to climb back out of it. So we tried to plan for that, and hopefully that won't come to pass. But the state revenue forecast is built around something like that happening.
Okay. All right. Well, that is
Thank you all.
it for me. Bring up Mr. Kringstad.
You don't trust me enough to leave this computer up there one night. One time I was preaching at church, and I thought I'd get ahead of things, and I left my sermon up on the pulpit. The song leader took it.
Oh, no.
That was an interesting couple of minutes.
Oh, you probably had it.
I didn't have my slides.
You would read it. You got it.
All right. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I'll get right into my normal material here. Just an update on production around the Williston Basin. We're still lagging slightly in the reporting from eastern Montana and South Dakota, but things appear to be a little bit normalizing coming out of wintertime as well in those producing areas. So we'll continue to keep an eye on that. But the Williston Basin, along with North Dakota, obviously producing now a fair bit above that 1 million barrels per day. On slide 4, just an update of how the crude oil within the Williston Basin is being transported to market. Some continued shifts. I'll just bump forward to slide 5 here. We saw a little bit of an increase in rail utilization in March. There's a little bit of market shift, but not a whole lot. And again, the numbers are quite small relative to past months. But again, that'd be the shift that you see. And then I'll also touch on here in a minute some more activity in the import-export portion, that green line at the bottom of this slide. So as you can see on slide 6, again, just an estimated slight bump up in rail utilization, leaving the Williston Basin. Slide 7, where those barrels are going. We're continuing to see that shift from the East Coast now with the West Coast now, PADD 5, being the destination for majority of those barrels leaving North Dakota. And I suspect now, long-term, that will be the trend. Any barrels that continue to leave North Dakota by rail, the West Coast will be the primary destination, just given the current market conditions and the coming shift starting here in the May-June timeframe with Dakota Access being in service. Pricing around the U.S. For the different PADD regions, those refiner price points. Continuing to see now the West Coast, PADD 5, it's the first time I remember this in recent history, being the highest price market for what the refiners are paying. That could also be playing into why we're seeing some of that shift from the east to the west coast on those barrels that still are moving by rail, and then followed up by East Coast and the Gulf Coast. Again, those coastal markets tied to the global oil prices more tightly than the mid-continent part of the U.S., and so no surprise that we're seeing those as the highest price markets in the U.S. An update of pricing as of today, $3 spread between Brent and WTI. and then about a $2 spread between WTI, that Midwest Cushing, Oklahoma price point, and the LLS, the Louisiana Light Sweet down in the Gulf Coast. And so if you remember my comments from previous months, that LLS is where the Bakken is expected to come in at when deliveries start down to the Gulf Coast. And so there is that price premium that we're expecting when those barrels do finally make it to the Gulf. Slide 10, this is what I was referring to earlier, some continued atypical type movements between the U.S. and Canada. Again, these are truck volumes across the border. Again, the exports being abnormally high compared to what we've seen in the past, and the imports following suit. So again, my explanation for this, obviously if there's trucks hauling one direction for a marketing reason, those trucks may be coming back loaded with a different crude grade, and again, for additional marketing reasons, we're seeing some of those barrels shifting and then entering the different marketplaces, again, primarily for marketing purposes. And so we will see in the next several months, once Dakota Access is in service, if this returns to a more normalized level, or if we can continue to see some of these barrels moving back and forth across the border. But it's definitely interesting, and it's something that's very difficult to find out a lot of details on, because again, the marketers that are doing this type of transportation and actions, those are typically kept proprietary. So other than knowing that it's occurring, I don't have a whole lot of details to explain exactly why, where, and who's doing it. Slide 11, getting into the gas, as Lynn alluded to, a slight decrease in the gas being flared. Again, that orange piece of the pie, that gas being captured from, or being flared from wells that do have a connection to them, is where we saw the increase in gas capture. Slide 12, again, coming out of the wintertime months, we're continuing to see month-over-month improvements in gas capture. Again, that orange piece of the pie, those wells that simply didn't have enough pipe capacity to move all the natural gas that they were producing, that is where the ground is being made up. That blue piece of the pie, the wells that are not connected, that's been hanging in pretty steady, right around that 2 to 3%. And then slide 13, again, just tracking how quickly the gas gathering companies are out, getting pipe in the ground, getting wells connected. Again, keeping pace, which is a good sign. As activity starts to move into the region, coming into the summer months, this is something we're going to want to keep an eye on, just to make sure that, again, gas capture, wells getting connected as quickly as wells are being drilled. And so in the coming months, this is something we'll all want to just keep an eye on, to make sure that, again, we don't get into a situation where industry is ramping up with new activity faster than the midstream companies can keep pace. And last but not least, just an update on the natural gas liquid production. So as you've seen over the last couple months, coming out of that wintertime decrease, natural gas production's been increasing. We've seen gas flaring going down, and so all of that coming together, and that more of the gas is being produced and captured and being processed, and in turn, the natural gas liquids that gets produced from the raw natural gas has been going up as well. And so just some indicators and some discussions of things. I should expect, or we should all expect, that these numbers will continue to grow over the next 3 to 6 months, and then going forward from there. So with that, I'd be glad to answer any questions.
Okay. Do you know the exact volumes that Tesoro refineries in Dickinson and Mandan are taking in terms of crude oil?
So the capacities of those systems, Tesoro and Mandan, 68,000 barrels per day is the typical flows through that system. And then the Dickinson refinery, also owned by Tesoro now, they've got a capacity of 20,000 barrels per day inlet volume.
Are they operating at that, or?
It varies month to month. I don't have any of the numbers off the top of my head.
Also, how many, or any estimates on how much is expected to be transported on DAPL in June?
I don't. And so the actual volumes, those committed volumes that shippers have signed up for, when a new pipeline system goes into service, they may have staggered volumes of when shippers will have to deliver all the barrels that they've committed to. And so that type of information is kept proprietary by the companies. And so we don't have a good sense, from day one when it goes into service, is it going to be running at, full utilization? Is it going to be a ramped up process as contracts go into place for various volumes? And so that'll be yet to be seen once it does go into service.
In terms of natural gas and processing, does the state have enough capacity right now, or are there still some things on the drawing board?
Currently, so the question was, how does gas processing capacity look for the region? As we sit today, in the near term, over the next year or so, the expectation is that we've got adequate gas processing capacity. The forecast is for growth on natural gas volumes out of the region. My expectation, we're going to need additional gas processing capacity. There are a couple plants that were delayed when the slowdown hit that are still on the drawing board. There's some additional plants that are in the works that companies are developing and doing some of the permitting work for. So we'll definitely continue to see investments in additional processing.
And a follow-up, the existing plants, are they running at near capacity or at capacity, or do you know it?
Majority of the plants are running very near capacity. And so, again, it just depends on geographically where they're located. If the plants located within the core where activities concentrated, those are well utilized. Some of the fringe plants where they've seen activity reduced, their utilization is typically lower.
Okay. What's probably the best day to consider an in-service day for DAPL? Do you know?
I haven't heard anything officially, from the company. Mid-May, so very soon, as soon as next week to June 1st are the date range that I've heard.
Okay.
So.
It's consistent with what this person wrote. So.
Yeah.
Okay. I don't see any other questions. Seems like it's it.
Thank you.
Wait, here we go.
Oh, there's no one.
Can you identify what companies are planning gas plants?
Yep. So there's the two that were pulled out of the construction schedule. One Oak had one facility. Target had another. One of the gas plants, Arrow Field Services, is in the process of getting some of the permitting work done for their gas plant. And then others, again, that longer-term vision, trying to figure out the timing. So really, from a midstream perspective, right now everyone is working hard to try and figure out how quickly volumes may ramp up again in the region, what parts of the play will get the most type of activity and the most production growth, so that those plants, again, can be put in the right location. But it's definitely very active in the midstream side, that they are working to figure out what pieces of the puzzle need to be put in place next.
Okay. With that, we'll end it.
Okay.
Thank you.
Thanks.